Hi, my name is Kris Venezia. I'm an advisor at Eckman Wealth Management, currently baking in New York City while supporting the Arizona Diamondbacks, who are hopefully going to begin another stretch run into the playoffs as we get to the last 2 months of the baseball season. Today, I'm not going to be talking about the weather or baseball, but I'm going to be talking about interest rates. One of the big things that is starting to happen is you're starting to see rates fall when you look at U.S. Treasuries, Bank of England cut rates earlier today. I know that doesn't have the impact as the United States Federal Reserve, but we're getting ready for, and there's an expectation that rates are going to start declining and that the Fed is going to start cutting rates as we get into September and beyond. So what does that mean for you on like a personal level? The big pros pretty obvious, but if you have a mortgage, for example, that you've gotten recently and we start seeing rates fall, certainly it could open up an opportunity for refinancing on the mortgage side. If you're somebody that's been looking for a home and mortgage rates have scared you away or made the housing equation unaffordable, lower mortgage rates certainly could help out in terms of the affordability complex of buying potentially that first home. Or if you're somebody that's been in a home and looking to downsize or looking to move, certainly lower mortgage rates makes the math much better when you're calculating selling this home, potentially getting rid of a lower mortgage rate to moving to that next home and that next mortgage, which will have a most likely higher mortgage rate if you refinanced or bought, in 2020 or 2021. But the math is certainly better if mortgages are starting to come down. Student loans, another big one, in a lower mortgage rate environment. If you're looking at your student debt, if you're trying to get a handle on student debt, I know there's so much crazy stuff happening there. That's a whole nother video. Um, Lower rates can certainly help in terms of looking at options and ways to refinance and get a better handle on some of those student debt payments. Of course, cars the same way, potentially refinancing a car loan, although there can be more hurdles to that. In terms of buying a car, certainly lower rates certainly help there. So that's some of the obvious stuff. Rates fall, some of the stuff on the consumer side, and certainly more helpful. I think the bummer that comes out of it is going to be on savings rates. Lower rates mean some of these high yield savings accounts, they've started to trickle down a little bit, in anticipation of rate cuts, but should continue to fall as the Fed kind of loosens monetary policy up over the next year. Means you're looking at lower savings rates in high yield savings accounts. If you're saving with like US government debt or CDs, certainly going to have less juice on those in a lower rate environment. And the big thing is with rates coming down and as rates fall, as I fix my mustache again, it's a great opportunity it's a great time, I should say, to take a look at your situation, to take a look at your debt situation, to take a look at the total portfolio, right? The cash that you have on hand, how you're investing that cash. And it's a good opportunity to take stock and say, do we need to make any adjustments here? Especially if you're looking farther out. If you hold bonds, they go up in value, certainly with rates falling. But if you're trying to build a longer term portfolio with an income side of things, falling rates, there's some maneuvers to consider, maybe some changes to that asset allocation to consider, so you're not stuck holding something earning a puny rate of return. On the business side, to kind of zoom out, I think on a larger level to talk about interest rates, it's funny that the big thing, kind of just talking with friends, is you think a 25 basis point cut, which is a lot of attention around it. People thought the Fed should cut in July, which they had their meeting yesterday as I'm recording this. Now the expectation is September. Market took a bit of a spill the day after Chairman Powell's press conference, August 1st, a rough day. A lot of people, I think, fairly attributing that to this belief with some economic data that came out on the morning of August 1st, showing that the Fed's maybe a little bit behind the curve and waiting too long to cut rates. But the big thing in why it matters is you can kind of see it in survey data. And the one that came up the morning of August 1st, day I'm recording this, was from the ISM. It's a survey serving manufacturers. And it was interesting to read a quote from it talking about, I'll just read it. Demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current federal monetary policy and other conditions. Well, the other conditions not really hitting as hard as the monetary policy point. And to kind of summarize that on what that means, more broadly is you do have businesses right now that are trying to make plans, and those plans are factored around interest rates, right? If I'm a business, there's let's use real estate because that's an easy one. If I'm a home builder and I feel pretty confident rates are going to come down, that lets me do two things. First, it starts to make me a little more comfortable about borrowing more money, right? Because I might be able to say, hey, in a couple months, let's make plans to maybe build more because I feel like in a couple months I can get a pretty decent rate, so I can get some leverage to build those homes. The second side of that is if you feel like rates are coming down and you're a home builder, you're going to feel like, hey, I feel more confident on the demand side of things, right? If I build these homes and mortgage rates fall, there's a much higher chance that there's going to be people that can come out and buy this home, right? More people will be able to afford this home. More people might be willing to move and sell their current home at that 3% mortgage to move into this new home I built that maybe mortgage rates are at 5.5 or 6%. The math works out better for them. And then you go further down the line and you think that home builder impacts so many other aspects of the economy, all the little pieces that go into a home. Think of a Whirlpool, which makes appliances, which go into the homes, and Whirlpool's been struggling because, we're not building as many homes, and rates have maybe kind of put the, not maybe, rates have, the higher rates kind of put the clamps on the housing market and the activity there. Think of a Home Depot or a Lowe's. There's so many components that go into the real estate. So much is impacted by that once the Fed starts that rate, cutting rates, even if 25%, that gives a pretty strong signal to people that, the rate environment might get more favorable for a better demand environment. Cars, a very similar discussion, right? I make the cars. If I'm a dealer, rates come down, I feel more comfortable about the demand side of things because I can get people in these cars in a lower rate environment. If I'm a startup business that relies, needs to not just raise money, but maybe borrow money, a lower rate environment makes me more confident in terms of making bolder decisions. Maybe I can hire more people because I feel more confident about my ability to borrow and pay the interest on any debt I take out. So on a larger level, when the Fed starts cutting, as silly as it seems for 25 basis points, as ridiculous as it is in 5 years, we're probably not going to sit there 10 years from now and say, if the Fed just cut in July instead of September, it doesn't feel that dramatic, but it really is a very, very powerful signal because it's giving a signal to everybody. Okay, you can take maybe a little more risk on the business side because you're feeling like, hey, the Fed's going to start cutting, and there's going to be this expectation that the Fed will continue cutting in most likely 25 basis point increments, throughout the future. Maybe not every meeting, but certainly, multiple times through 2025 is definitely the expectation right now. So on the personal side, as we get ready for lower rates, and truthfully, lower rates are happening on, the U.S. government debt, which does have an impact. Look at your portfolios, assess your situation, make sure you're positioning yourself in a good spot. If you have questions, of course, reach out. On the business side and on a larger side, there certainly is an impact to when the Fed cuts rates. And of course, as the market showed on August 1st, there is also that side of if the Fed waits too long, do they do too much or they start doing damage to the economy that just can't be fixed with a 25 basis point cut? Thanks for listening. Hope and watching. Hope you learned something out of this. And questions, comments, you disagree with anything I said, leave it in the comments section. Happy to engage there. Thank you.